Okay, so Jim, why don't you take it away and introduce yourself, and then we'll jump in a little bit later.
Okay, great, Buck. So thanks so much for your time and for all the members of your group. We're looking forward to digging right into today's subject matter. And today we're going to talk about the way that the custom conservation land strategies can be delivering very meaningful tax savings to your group and the members of your group. So as we kind of get warmed up here, I just want to welcome everyone to the call. My name is Jim Sullivan. I am the VP of Business Development for. All right, I'm unmuted. That's good.
Sorry about that.
That's quite all right. I am the VP of Business Development. We are a Georgia-based firm. We also have offices in Florida as well as California, so we are national in scope. As we roll forward, just fasten your seatbelt. We're going to cover a lot of material, and then we're going to hopefully be able to open it up in about 20 minutes for open question and answer. So, of course, as we get started, as per you would expect, today's call and this webinar is not in any way an attempt to present or sell securities, nor are we doling out any kind of accounting or tax or legal information or advice for that matter. So just be careful to take today's input in and see your advisors for its applicability to your particular situation. What we are going to talk about is a way for you to help you get your financial goals met faster, because anytime you save tax dollars, you're able to direct those monies as newfound monies toward your financial goals, whatever that is, whether it's funding your retirement, your children's education, or your grandchildren's education, or enjoying a nicer vacation this year, whatever that might be. But it's your legal right to arrange your affairs in a way to legally lower your taxes. And we're going to be covering one that's been in the tax code for decades. So though it might be a new concept to you, it's by no means new to the tax code. So just a little bit about our firm, Forever Forests. We are a direct consulting firm dealing directly with landowners to preserve assets, land conservation firm to preserve land for legacy purposes. And then we'll also work in situations where individuals who want to save land and save money on their taxes can either acquire a piece of property that we've got in our select reserve, which is a predetermined, pre-qualified list of properties that are ready to conserve and ready to buy, or if that's just being a fractional member in other opportunities we have through our networking with landowners. So this is a great opportunity for environmentally minded and tax motivated individuals to make an impact. Our company was founded by Nancy Zach, who's got 18 years of experience in conservation easements. We've been in existence since 2002. We've managed over 100 projects coast to coast in the United States of America. And these conservation easement projects have generated over 38,000 acres preserved in perpetuity for generations to come. They have kicked off over $1.1 billion in federal tax deductions, and in addition, over $24.5 million in state tax credits in addition to those federal deductions. So it's a meaningful footprint, and that said, with that type of footprint, we've yet to see less than 1% of those deductions ever undergo any administrative adjustment from the Internal Revenue Service. So there's no fingers crossed in that respect. It's all about intention and a meticulous attention to documentation and good sound project management. So, we trust that you'll find that those are impressive statistics and impressive numbers, but it's not the only number that it impresses upon us at Forever Forests. The number 6,000 means a lot to us at Forever Forest, and that is because there are 6,000 acres developed every single day in the United States of America. And so we see that happening, and all of us need to enjoy open spaces. The biodiversity of our world is important to the well-being of all individuals. And so we're not tree huggers where we think that there should be no development. We just think that we should do it sustainably. and so that we can have open places to go play with our children and our grandchildren, to ride horses and to go farming, or we need a bread basket in which we can grow food, for example. So we're just about sustainability, and that's what these particular government incentives were put in place for. So to date, there have been almost 25 million acres permanently conserved in the United States of America through the use of conservation easements. And that's a pretty big number. I share that with you because I want you to understand that conservation easements is not something that's been happening in a corner anywhere. As a matter of fact, if you were to take all of those easements and put them up to create one big landmass, it would almost match the amount of acreage in the entire state of Washington. It's just that it's peppered all over the United States and its related territories. So it's certainly a daunting number. But all that said, though, with almost 25 million acres preserved, at today's rate of development, it would only take 11.3 years to develop that much acreage. So we're thankful for what's been preserved, but as we continue to develop, we need to move ahead responsibly. This next graphic is intended to help you understand the important role private capital plays in land conservation. You'll see here from the conservation easement database that the largest majority, over 90% of property under conservation easement, is actually held in the private sector. Many people think that, you know, government parks, state parks, city parks, that these are all this is the largest portion of property that is owned or, you know, under conservation easement, and that's not the case. Now, certainly governments can own property, but that just because the government owns property, folks, doesn't it's actually permanently preserved. That's important for you to know. So landowners are conserving their property. 6 out of 10 of the top landowning families in the United States of America enjoy meaningful assets under conservation easements. And some of those noteworthy family names would be like John Malone or Ted Turner, for example. As a matter of fact, whether you like our sitting president or not, even Donald Trump declared tens of millions of deductions for assets he has under conservation easement. So a conservation easement is the right thing for certain circumstances, and it meets a need for a number of parties with a number of different objectives. And the first would be for landowners who own property that has conservation value. And a lot of times the tax benefits of that property, because it's such a highly appreciated asset and so valuable for development purposes, that it can have tax reduction value and deduction value far in excess of what that landowner may need. So they can actually creatively partnership with other high net worth taxpayers to share in those deductions and share in ownership. And all this is good and fitting because federal and state governments have been playing the conservation, playing a role in conservation going back to the 1870s, as you may remember, with the the creation of the first federal park, Yellowstone National Park. If you move ahead into the Teddy Roosevelt administration in 1903, he created the first federally protected fish and wildlife preserve. And so he used the bully pulpit to advance the cause of conservation from the executive wing like no one before. Until during the Carter administration, there was the first toying around with a conservation easement deduction in the late 70s, which is finally signed into permanent law by a rugged outdoorsman by the name of Ronald Reagan. And as you may remember, not only was he a rugged outdoorsman, he was also a strident, a believer that if there was anything worth doing, it could be done more successfully and cost efficiently in the private sector. So this is a way for him to privately inspire land conservation in the private sector. So a deduction was created where you could deduct up to 30% of your AGI with a 5-year carry forward at that time in 1980. So you're talking 37 years ago. That's how long this has been in the tax code. Fast forward to 2015, Congress evaluated, after a decade of evaluation and experimenting with more incentives, decided that this is worthy of a deduction up to 50% of one's AGI with a 20-year carry forward on surplus deductions. So Congress generously bringing permanence to this and incentives that would really inspire land conservation in a new and historic way. So the government involvement is long and storied, but it didn't stop there. Actually, there were some surprises that were thrown at the land conservation community at the end of last year, and actually to the tax planning community as well, which I'll get into in a moment. I don't want to mention that this also meets the need for federally recognized land trusts. These are non-for-profits, and these are the parties, the organizations, the 501c3s that receive the donations of conservation easements. So when a landowner gives that away, that's where that's going, whether it's in a partnership structure or otherwise. So as I mentioned, there was some very surprising Obama midnight regulations where the Treasury Department, in the last hours of the Obama administration, is actually just on the eve of Christmas Eve. They sent a little Christmas card. You might remember this infamous fellow from the Home Alone video, where he said, "Merry Christmas, filthy animal, and have a happy New Year." It's just kind of a comical turn on a turn of events in that the Treasury made this, as well as a number of other tax saving strategies, what is known as a listed transaction. Now, those of us in the land conservation community are well familiar with our transaction being one of a highly disclosed nature. So for us, this is essentially added another number of, it adds Form 8086 to the tax return as a disclosure and a number of attachments. But we're already well acclimated to reams of paperwork and documentation already disclosing. So I don't mean to minimize it, but I also would say that when this is being done correctly, you got to realize that as the Treasury issued this, they didn't make conservation easements or in partnership transactions and syndications, they didn't make them illegal. They just made them, they just put on them an onerous paperwork burden. So, but we've actually gotten a great amount of counsel on that, and are able to generate those forms with suggested language in a way that will more than satisfy your tax preparer. So we can certainly answer more questions about that. And what's encouraging about that is that our lobbying arm has acquired significant majority support in Congress to actually suspend or revoke that because they believe that all taxpayers should be able to take this type of deduction irrespective of the type of structure, irrespective of how much they have in basis in the property. Actually 4 congressmen in the last few weeks have written, and we have the letters, they've written the Treasury, Steve Mnuchin, the Treasury Secretary, calling for him to suspend that particular measure because of its onerous burden on the taxpayers. And the suspension is a call so that Congress can fix the problems that they think are in existence. Because there's a few bad promoters out there, they make something bad, a few bad apples kind of start affecting the whole barrel. So what we're talking about today is these government inducements on essentially conservation capitalism. This is a way to invest with landowners and landworthy, and you can feel good about saving the environment as well as saving significant funds in taxes. So what exactly is a conservation easement? Well, it is in a very real way a deed restriction that permanently prohibits commercial development on property. And so people give away the easement, but they continue to own it, and then those rights are donated, and it pushes back a charitable deduction to the donor. And that can benefit a number of different parties. Of course, it can benefit landowners, but what if you don't own qualifying land right now? Well, that's where you can consider participation in a real estate partnership that owns an asset that qualifies for this type of tax treatment. These types of real estate partnerships will typically pose a threefold investment consideration, either to develop the property or to hold it for a period of time for appreciation, or to actually conserve it. And upon the election, there would need to be a voting election for this type of among the membership that would create the conservation partnership where the property is conserved forever. And so the partnership is essentially forever foregoing the economic benefit of developing for the economic development, the economic benefit of conserving, which would mean tax savings. And this can make great sense for individuals in all kinds of different tax circumstances, most notably if you're paying the highest tax brackets. But you can see here on the screen that there's all kinds of different tax circumstances that would make considering participating in a conservation initiative a meaningful tax play for you. So what would be the benefits of going green with a conservation partnership or a conservation easement for that matter? It's my understanding that the largest portion, or maybe all of this investment group, are medical practitioners, many of you working in cosmetic, in the world of, you're working in aesthetics. But there
No,
isn't any tax
just
credit.
to interrupt real quick, they're all accredited investors. A number of them,
Great.
sorry, I've got laryngitis. A number of them are in the medical field, but they are all accredited investors.
Okay, great. I appreciate that, Buck.
Yep.
So it's great to, it's great to be in a business where they issue tax credits based on your performance. But if you're not, this is a way for you to receive the tax benefits of green business, where you can diversify your investment activity and be recognized with the tax incentives likened what to what is offered to solar or wind or other industries. So as I'd mentioned formerly, you can realize the deduction up to 50% of your AGI this way. And so the question is, what would your basis be in the property to do this? Because you would in effect self-direct money that you would otherwise be paying in taxes into this type of structure. And so you could enjoy meaningful savings on the federal level, as well as there are 30 states that recognize the deduction. So depending on your state circumstances, you may save there as well. And from time to time, there are also state tax credits offered. And so we don't have any state tax opportunities, state tax credit opportunities available this year that I'm aware of yet, but that can also sweeten the pot as well. So moving ahead, when we consider conservation partnerships, these typically will take shape and form in two different ways. In the end effect, when a partnership elects to conserve its property versus develop it, that could take form in a conservation easement or even a fee simple gift to the land trust. And that would result in the partnership actually giving the property away. So by comparison, let me just distinguish these from each other so you can understand their distinctions as well as their relevance. The first is that in a conservation easement granted. The second would be that fee simple ownership of the property is being given away. The first for a conservation easement is that there are strong conservation purposes where a fee simple gift is employed when the conservation purposes are less than premium and the property is less than in its pristine, untouched natural glory. In addition, as I said, CEs get a deduction up to 50% of your AGI. Fee simple gifts are just at 30% of one's AGI. As it relates to IRS scrutiny, a conservation easement has a 30-point IRS test that we're well aware of and well accustomed to working in compliance with, so that we know that we can stand under that type of scrutiny should it arise. But then there's a 3-point IRS test, much simpler test as it relates to fee simple gifts. So you can see it's lesser incentivized, there's lesser scrutiny as well. So when these fee simple opportunities are available, which they are rarer, it's something to consider. So let's talk as we're coming to a close of my portion here. I want to explain to you how these deductions have their start and then how they end up yours. So start with a piece of property here represented on our screen. This is a highly appreciated asset under development pressure that is valued at its highest and best use. And then a second valuation is done of what that property is worth with little to no development potential. So let's say it's worth $10 million to the developer, highest and best use, but only $2.5 million if it's conserved. Well, then that's a $7.5 million deduction to the donor. Well, that's good if they're making $15 million this year because they can take that deduction in 1 year. But they may choose to employ an approach where they can monetize that so that they can realize a quicker cash-on-cash realization from those deductions. So the property is put into a partnership structure where individuals can invest in that structure. And then that gives the individuals the opportunity to have a voting membership, and then they vote to put the deed restrictions on the property. It's conserved, and the land trust assumes that important monitoring role. And then all of the partners are recognized for their fair share of the charitable deduction, prorated with their ownership. So this is essentially the way that the deductions can be therefore shared with other qualified investors. So let's take a look at a tax return and see what that looks like. Here's an individual making $1.4 million on line 37 of Form 1040. This was provided to me by one of our tax planners who work with a client who's chosen to use this strategy. You can see that before employing a conservation easement in this particular tax year, they had $216,000 in itemized deductions. And that you see here is their Schedule A, that 216. This was actually their second year of employing this strategy, because they had 217,000 in carry forward from the previous year. But it made sense for them and their tax planner to employ the strategy for a successive year. So what they chose to do is do a little bit more tax planning. They got some more money retained in the business. So their AGI went down a little bit, but it's still closer to 1.35 now. And then what they did was they were able to supercharge their itemized deductions up to $650,000, you'll see here. And when we take a closer look on the Schedule A, that essentially was because there was a $440,000 deduction on line 17 as a qualified conservation contribution. So you can see the little bit of carry forward they still had here, but now their deductions have been majorly supercharged. And so when we look at that in a before and after capacity, we see here that their total tax went from $415,000 down to $223,000. So when we contemplate what it cost them, their basis in that property was actually $100,000 in capital contributed to the South Atlantic Coastal Reserve, and that generated a $440,000 deduction. So you see 4.4 to 1 deduction for every dollar invested. And the beautiful thing about a conservation easement is their deduction is not limited to their basis. So it could be very useful in savings. So we see here in the end effect that the conservation easement saved them $173,000 in taxes. It cost them $130,000 to get into the partnership for that interest. So their net savings, net of their participation, is $73,590. So you're talking about meaningful savings for sure. And when we facilitate this, your tax preparer will get a full docket of all of the required documents for filing purposes. You're able to enjoy a season of ownership in this, and then there's typically some type of exit strategy that will happen where you're not in this inexorably, and there's going to be some period of time where this thing is going to unwind. As far as the related risks, there are no asset protection risks, given that your only capital ever at risk from a civil litigation vantage point is what is in the partnership. And given that you're accredited investors, you'll understand what a limited partner is. And then the final thing is, as it relates to the tax risks, when this type of deduction is on your Form 1040, the IRS actually cannot audit or change your deduction. It actually requires a TEFRA audit, which is an audit of the partnership. So those are generously held in, there's funds held in reserve to cover that, so that there aren't any additional capital calls for that. So with our track record, we've got a good handle on these types of structures and had a good handle on all of the legal ins and outs of them. So with our track record, you're in good hands, capable hands. So you can feel good about preserving property, as well as generating some meaningful savings as well. So with that in mind, we're able to take some questions. Buck, I will say that as individuals contemplate this for this year, things are well underway. These are sought after tax savings opportunities. So we would suggest you get with Buck so that you shoot him an email, let him know of your interest, so that he can get you with our team, so that we can size it up and make sure it's a good fit for you, entirely suitable for you, and can go to work for you. So Buck, what types of questions have we had come in, or would you like to field those now?
I'll excuse me, guys. I've got laryngitis, believe it or not, but I'm going to ask. I'm going to wait a few minutes while these questions come in, and I have a few things I want to ask, and also make comments on, because I've actually utilized this strategy for two different occasions. And so every question that you have and concern that you have as a group out there, I've had. Now understand that my whole, the whole show and everything I'm trying to do right now, the idea is let's try to take away the veil between us as, the well-to-do professionals away from the uber wealthy. And this is one of the things that I think falls in that category. You heard from Jim that guys like Ted Turner and Donald Trump and, all these guys been using this for years. So why don't you know about it? Well, it's because there's a veil between you and them, and that's what we're trying to do here. And then things like the Obama thing are just really, I mean, honestly, folks, you can't and I'm not telling you what to do. I'm telling you how I feel about it. We're not doing it. This is not illegal, right? There's ways that the IRS and stuff are trying to scare you. But there's a couple things to notice here. And one is what Jim said is that if you have something like this, it's not like somebody is going to, audit your personal returns for the conservation easement. If there is even some sort of audit, which Jim can talk about the frequency and what happens in worst case scenarios on that, what you're really talking about is an audit at the general partnership level that has nothing to do with you. Correct me if I'm wrong, Jim. And so
no, that's correct.
And so what I'm trying to tell you is that it sounds when you look up on the internet, and perhaps you guys can talk a little bit about the Forbes articles in particular, which always serve to scare people away from what I think is a very, very smart idea and concept, especially if you're with the right team like Jim's team. But if you can speak to kind of what I've said and specifically talk about, the types of things that people are talking about in the articles on the internet.
Sure. So when you read the articles on the internet, basically are you typically published as an attempt to present what they're trying to make it look like some exculpatory, study on an abusive tax shelter, and to take that and to basically project it onto anything else like it. There are certainly, wherever there's anything in the tax code, there's always historically been somebody willing to abuse it. But that's just really actually what it was. Actually, most people would be astonished to know how many audits there are on 401ks, and how many of them actually, the highest percentage of them do not pass audit with the authorities and end up being subject to fines. So monies in your 401ks actually get soaked out because it's investment capital going to pay penalties. But that said, these articles are typically taking a case study of what somebody with a nefarious mind or bad motives, or as I showed on the screen, people who are less than noble in their motivations, are looking to do something funny with the numbers and how they can get away with it. So, but a company like ours just doesn't do that. We've been doing this for 17 years, and we've got a big footprint. So we know what it's like to go toe to toe with the service. So a lot of these articles are written to generate hits on their website. Forbes wants hits on their websites. Wall Street Journal wants hits on their website. So if they put a big inflammatory, headline, that's going to get clicks on the website. Then you read halfway into the article and it says, oh, well, actually, for every fire, there's a fire extinguisher. Oh, well, they should have said that in the headline. So, I hope that perhaps speaks to some of that.
It does. And I guess the other question, I think, the way to think about this, and these are the questions that I asked, frankly. Okay, so in your experience, what happens if something is challenged? Okay. And say you have a 4.4 multiple. I think that's what you showed up there. Let's start with that. You got a
Yes, sir.
4.4 multiple and the IRS comes in and they challenge. What has happened in the past? What is the likely outcome of a typical situation? And what's your experience?
So the 4.4 multiple, number one, everyone must realize that that is your first barrier of risk mitigation. What that means is that if someone is a properly accredited investor, they're paying the highest tax brackets. For every dollar they put in, they may be seeing $1.50, $1.60. State and federal combined, they may see $2 in savings, depending on if they're in California, they could be paying 53% of their income in taxes. Some of you guys in New York City, that's what you're paying. The 4.4 multiple in that story is really intended that if there's IRS scrutiny on that, it's got to go a long way before you're losing $1, because they've got to disallow 45% of that deduction before you're losing $1. So what on first blush looks too good to be true is actually you're looking squarely in the eyes of what is your first barrier of risk mitigation. And I say that to say because as I showed you previously, there's actually 30 points of scrutiny that the Internal Revenue Service could look at as far as different angles of scrutiny and perhaps finding technical footfalls on a conservation easement. Now, roughly, there's 6 to 10% of all conservation easements just get pulled for audit by a special detachment of about 45 to 50 auditors. That is a special cadre of conservation easement auditors. And actually, they've done a world of good for the conservation community because they've pushed out the abusers. And that's a good thing. We see that as a good thing. But we do know what it's like to go toe-to-toe with the service. And we understand that of those 30 points of scrutiny, there's actually about 28 or 29 of them that are all about technical footfalls. And that could be, say, you own the property, but you didn't own the mineral rights, so therefore you didn't fully own the property, so therefore deduction denied. So we spent a lot of time making sure that the clear path of ownership is undisputed. Or turning around and saying, well, I just read a case study a couple of weeks ago where a structure like this, a $64 million deduction was disallowed because somebody wasn't watching the store for the client. And when the nonprofit wrote a letter recognizing the gift, they did not include the sentence, no gifts or services were received in exchange for this gift. No goods or services were received in exchange. It's what they call a contemporaneous written acknowledgement. The giving receipt was in the file, but it didn't have that sentence on it. And so even though they went to tax court, they still lost. What a tragedy, because somebody did not make sure that was written correctly. So we've never had any technical footfalls like that. And so when it comes down to it, when they can't find technical footfalls, they'll go ahead and argue about the valuation numbers. And so for the small handful of projects over our history that we've had go into audit and come to resolution, they've come to resolution where the service could not just arbitrarily disallow the whole deduction, and they had to argue about the numbers. And so there's no change stories, and we have a no change story where it stood firmly to the line and there was no change. And then the other handful of occasions, the taxpayers agreed to just take a bit of a haircut so that they didn't have to continue to drag it out and go into tax court. And so, but no investors lost money, and that's actually the very big key thing. So when I say we've got over 1.1 billion in deductions out there, less than 1% of them have been administratively, adjusted. No one actually lost money in those occasions. They just ended up paying back some of the taxes with no penalties or interest, because that's just the way. That's the administrative penalty process. To the way that it goes, most people don't understand that you can get audited on something, and then if you disagree with the audit outcome, you can appeal. And then if you're dissatisfied with the appellate process, then you can go to tax court. So there's different levels. So we've been able to either see these things go to the appellate level. We've never been to tax court yet, but we do know other firms that have handled those. Of those, actually, interesting statistic this year, there were 9 conservation easement tax court proceedings in 2016. 7 of them, the taxpayer lost, and it was all because of those technical footfalls I was telling you about. 2 of them, the taxpayer won, and those were the ones that were actually about valuation and about appraisals, and the taxpayers won in those. So our track record is actually along those lines. We've never lost anything from a technical fault, and so we're in good shape, in that respect. So hopefully that demystifies that a little bit for you, Buck, and for your listeners.
Hey, everyone, I don't know how to turn, somebody's making a lot of noise out there. I've tried to turn everybody off, but if you can mute, I don't know what's going on.
It sounds like you got in and out of your car a couple of minutes ago.
Yeah, no, I'm sitting here, but I try to mute everybody, but somehow it always seems to work this way. But at any rate, it's gone now. Let me put this in perspective. And again, I'm not selling this stuff. I'm just telling you from my perspective why I feel safe about this. First of all, I think we got a good team, a great track record. The other thing, guys, is that even in the absolute worst case scenario, which has not happened with these guys, and you've got the president of the United States doing this stuff, and even in the worst situation, even if it did get turned down, if you are able to keep that money for 2 years and all of a sudden somebody asks you to return it, well, guess what? Maybe you made 15% per year on that money. My point is,
right.
I don't think, first of all, I don't think the likelihood of something happening given this team is high, and that's why I chose to move forward. But even if it did, the amount of money that I can make on that money in the interim is worth it, because it's not like you're gonna something happened, you're going to jail. I mean, this is just this is how the wealthy do it, folks. So I want to put that in perspective, and again, I'm a big fan of this model, and I'm going to ask some questions here that others have asked. And Matt asked a good question and a really useful one. He says, if he's all W-2, can he use this on after-tax dollars and get a refund? And as I believe it, that's exactly right. You can't, right?
Yes, you can. The deduction is useful against income from all sources, and so it's very popular amongst highly compensated W-2 professionals, and you'd be setting yourself up for a very generous tax refund. That's correct.
Nelson asks, well, I think he's wondering where the land goes. He says, can you give more detail on the exit strategy? And is it for so many years? Is it after how many years? So I think he's kind of figuring, he's thinking of this as a development, and what happens to the land? And, is there something that happens over time?
So as we covered, the conservation easement is the development rights bundled off and broken off. So the conservation partnership still continues to own the property. The reason why I mentioned like a few years is that there's typically an operating reserve and a legal reserve that's held in place, that's funded out of the original capital raise, and that's also intact if it got audited. After a 3-year statutory window of audits possibility and vulnerability, there's then therefore now consideration as to what to do with the land, which the land could just be sold, or it could be that the original issuer now buys back everyone's interest because they've had an affinity and a love for that particular property and want to continue to retain it. Usually investors are happy to let that go at a very, de minimis amount of money because they've gotten such rich returns through the transaction in the first place. And incidentally, that's not unlike what's done a lot in the renewable energy sectors. Actually, in the wind industry, there's something called the Minnesota flip structure. It was first originated in Minnesota, where there would be a flip back of ownership. So that's one exit strategy. Or there could be there could be a couple of lots outside the fold of the conservation easement that could therefore then be developed and then generate other returns. You just got to read the PPM, and you got to see what's in the PPM and what other considerations might be there. But I hope that demystifies a little bit of what might happen in the exit strategy. It's just not. It's something you're not going to get, and K1s, between now until Kingdom Come on, because there is going to be an unwind somewhere in the foreseeable future.
I mean, the way I've seen it, the way I've looked at it is you're basically, obviously you're buying a piece of land, but at the end of the day, from a tax perspective, you have to look at it as you're buying a deduction. So don't expect any return on that later. If it happens, that's great, but that's not the idea. Is that fair?
That's right.
Right.
It is fair, except I would adjust that you in the end effect, you realize the deduction. Technically, there is no way to sell deductions. And so, I just adjusting for technical sake to not say to anyone you're buying a deduction, because you're buying interest in real estate.
Right.
You're part of that voting membership. You're receiving a deduction for the charitable gift. But, that might be semantics, but it's fairly important to understand.
Yeah.
Because tax credits in certain contexts can be sold, but deductions can never.
Jerry asked, back to an audit question, with a large refund, do you see a greater chance of an audit?
You could look at the audit risk. The greatest audit risk most of your participants here on this call have is the amount of money that they're making. Okay, because if you're making 200,000, you've got up to 200,000, you get a 1 in 4 chance. Well, I guess a 2% chance of getting audited. If you make more than 200,000, it's basically that quadruples. It's a 12% chance, I think, or something like that. But if you're making up to $1 million, then it shoots through the roof. So that's your greatest audit risk. But there's no history of big personal audit scrutiny at all in the hundreds, perhaps even thousands of participants. As I sit here and talk to you, I was speaking to a group of tax preparers, 70 of them in San Diego last week. And there was one gentleman with whom I've been working in this context with since 2009. He stood up before the whole bunch and said, I had a client, he did this strategy. It was a no change on line 17 of Schedule A because they pulled it and then they realized they couldn't change it and then they just closed it. They went through the other stuff and there was no change. So I think it's always good to make sure that everything else is tidy on your tax return. You should always do that anyway. But as it relates to, there isn't some rash of audits that I could report to you that you should be concerned about amongst individuals who have employed this strategy. It's just not the case. And the occasions when it's happened, it's just been no change, candidly. But you should make sure everything else is tidy for every reason, that if you're making a lot of money, you're going to have a higher percentage of likelihood for audit. And so if there's anything you're doing, tighten up your ship.
I think that's generally pretty good advice. And,
Yeah.
I think let's see, Matt is asking, let's see, when is capital usually raised? Is it always just the last quarter of the year if I have lazy capital to employ before tax year ends and get a quick turnaround refund, or is it something you kind of have to work on earlier in the year?
It's becoming earlier and earlier in the year. We've never actually seen it so early. In as much as we touched on certain points of scrutiny earlier in our call here today, we've never seen early interest and a crescendo of such high net worth interest. So that does mean that your capital is tied up longer before you see the cash on cash return in the form of savings. But we're talking about such great returns that I don't think that's anything anyone should bemoan. It's a fairly quick turnaround when you're talking about 12 to 18 months or something like that between now and whenever you file your taxes, even with extensions considered. And I'll speak well to give kudos to you, Buck, on your concept of the time value of money. When you're saving money this way and you put it to work for yourself for 3 or 4 years, you're going to get returns from the time value of money. And many advisors and tax preparers do this because they know that there might be tax risks, and in the worst day, they might have to pay some of the taxes back. But meanwhile, they kept their money in their own coffers, growing toward their financial goals. And that's actually was a really good point you made before that I wanted to underscore. I was looking for the opportunity to do so.
Let's see. To that point, Matt, I also want to ask or answer my experience as a consumer. of these in the last few years has been I had 1 year that I did this that I almost didn't get in because I waited too long. So if you have a predictable salary, I think you were the W-2, it might be a good idea to project this out and maybe not wait till the last minute, because I would have ended up paying a couple $100,000 more in taxes that year. So I would think about doing it earlier rather than later if you were inclined to do so.
I would
Um,
agree. We have deals open now, and we've never actually had them this early. So we've got them open now, and now would be the time to do it because of the crescendo of interest. You could call us, you could reach out to Buck in November, and he could say, yeah, but the guys we were working with, there's no more supply. Sorry, you waited too long.
yeah, and
Let's get it under the scope now. If it makes sense, let's do it, because
yeah,
it's not like stashing money in an IRA at will,
and listen to the point, and there's not a lot of groups out there that I think I feel real safe with, guys. So I mean, there are other conservation folks out there, but I think Jim has mentioned. I mean, some of them are the problem, right? So if you can get
Oh,
in here early,
there's definitely deals out there that are to run away from. We've seen them. We've been hired to do due diligence on them, and so that's why we're in support of Congress changing things and isolating abusers. We're just not in support of the methods that they've constructed through the Treasury right now to make it so onerous.
yeah. So, and Nelson had a question. I'm not really sure I understand, but he's looking for a way to move money from a traditional IRA to Roth IRA. This seems to be a great strategy to do just that. How
Hmm.
it would work. I think, Nelson, at the end of the day, it's money's money. If you end up moving it, I mean, I don't know that it makes, I don't know that I would have thought of this as an IRA play, but maybe I'm missing something. So, um, Jim, what do you think of that?
Well, we've had clients that have examined that, and we've worked with them. As a
Mm,
matter of fact, the CPA and his father did just that. They did an IRA conversion in the first year that you technically do so in 2010, and it was a real win for them. When you're contemplating an IRA conversion, you're gonna use the right types of calculation tools that are ultimately going to help you to determine to convert or not to convert, and you're going to take all of your financial realities in mind. And of course, you convert because you believe that you're going to pay, it's going to be a better tax play in the long run. That if you can pay the taxes now and continue to grow the assets tax free, that's going to make sense. So when you figure into the fact that you can cut the taxes net of your investment when you convert 20 to 30% by using this strategy, that's a whole nother figure and a consideration when you're considering to convert or not to convert. And so you got to work with your tax advisor, or get that under review if you feel like you're capable of making that determination yourself. Your financial advisors and so on. And we'd be happy to get on the phone with them to help explain this to them, to help them understand how they could offset the income influx from the Roth conversion, and then model it out. It's all based on the numbers. But we have had people who have done it, and it's been a real win for them
that's
when
interesting.
they were properly planned out.
I wouldn't have thought of that because I would have thought that the Roth money would ultimately, you couldn't really deduct that. How would that work?
Well, no, you're not. Remember, you're not using money in the Roth to invest into this. Okay,
Right.
what you're doing is when you can fundamentally, for those of us who are unfamiliar with it, when you're converting money from a traditional IRA to a Roth IRA, you're taking something from a tax deferred state, and when you convert it to a tax free state for growth, you actually have to pay the taxes on that conversion. The beauty of how George Bush changed the rules in the mid 2000s for the Roth conversion rules that ultimately came available in 2010 was that a high net worth individual could now, for the first time, fund a Roth IRA, where somebody who was younger, somebody who made smaller income thresholds could do that. Somebody had a lot of assets, you could convert it into the tax-free growth structure of a Roth, but you had to pay the taxes when you do it. Free of penalties, but you had to pay the taxes. And so what do you do with that? It almost looks like a windfall on your tax return. So in effect, you can cut those taxes very significantly when planned out right by this means.
To the one point I had to bring up is that a lot of you are going to be working with CPAs who they're going to see this stuff and probably faint, right?
Mm-hmm.
And so this is something that definitely Jim's group would probably want to talk to them about. As an aside, I want to point out that I've been sending out these Tom Wheelwright tax, downloads. I strongly encourage all of you out there to download this stuff and watch his webinars. Because if you're wondering where I got the idea of conservation easements, it's through Provision and Tom Wheelwright. So I'm not sending these things out just for fun, guys. I mean, this is the kind of stuff that saves you a ton of money. And guys like Tom, they in Provision, they work with Jim's group, and they do this stuff all the time. So if you've got a CPA who looks at this and says, "Oh, you can't do that," or faints on the spot, then you need a new CPA, because you need to the tax law is broader than most CPAs see it. Would you agree with that, Jim?
I would absolutely agree with it. And, we are very acclimated to spending the time with your CPA to take them through what I would call a conservation conversion. We've got to help them understand what's behind it, because when if they're a tax preparer or tax planner with any salt, they've seen their fair share of things come and go. So we have to explain to them the internal nuts and bolts of this so they understand how it works. And so we'll be very amenable to walk them through a presentation like what you just sat through today, and then provide them with reams and reams of documents related to the tax due diligence side of things. But in the end of the day, what we find is that many tax preparers are more interested in covering their own butt than they are helping you legally lower your taxes. And some of them, do not spend the time in researching things, and so they're not all considered equal. You've got to make sure you're working with a tax preparer who is acting like a fiduciary when it comes to your dollars. That you should not be arbitrarily just overpaying in your taxes. You should take every legal deduction available to you under the sun.
Jerry asks, if you are W-2, I assume that we should work with our CPA to have our W-4 adjusted, correct?
You could do that. If you dial down on withholding, then you're, in the end of the day, you're going to experience the benefit of the savings in your pay periods. You're going to see more money retained in cash. If you didn't, you could just stay your existing trajectory of W-2 withholding, and you'll just see it all come to you with that Department of Treasury check that comes to you after you file. So it just depends on whether you want to have that dramatic feeling of seeing that check come your way, or you want to just kind of see it in retained earnings through the course of the year.
Is there any other questions, anyone? I had one more question that you mentioned that I didn't that I didn't know anything about. You mentioned some possibility of additional layer of state tax deductions in 30 states. Can you talk about that a little bit?
Yeah, so the conservation easement deduction, as well as even the fee simple deduction I was speaking about earlier, they pretty much follow the rules of the charitable deductions in any given state. Now, of course, there's some states that don't exact income tax, say for Florida or Nevada or Texas, but not all states that collect income taxes recognize the charitable deduction. For example, in Illinois, they don't let people itemize, period. Okay, or then there's other states like Pennsylvania where they let you itemize, but they just don't itemize. They don't let you itemize. There's a carryback of the charitable deduction. Massachusetts was astounding to me. In 2000, Massachusetts voters by voter referendum approved the charitable deduction for their state by voter referendum. And then the Massachusetts Department of Revenue just arbitrarily suspended that a year later and just voided it out. Okay. So, we have good research that we can typically indicate whether you should expect a state deduction or not. And but you ultimately have to run the before and after tax return. An interesting thing, for example, is California recognizes the deduction, but they don't recognize it up to 50%. They're still stuck at 30%. So you're going to have some carry forward on the state level, but not on the federal level. So, we're well versed, having worked with individuals really in all 50 states, to know what you should expect. And then the truth be told, the before and after tax return is going to say it all.
We're going to wrap it up here. Jim, this has been fantastic. And I sure hope people understand how powerful this technique is. And certainly if you want me to connect you with one of the, the broker dealer who works with Jim, email me, buck@wealthformula.com, and we'll get you hooked up. And I would suggest, if this is something appealing, you move pretty quickly for the reasons we talked about. And, hopefully this is helpful. And Jim, thanks again.
It's my pleasure, Buck. Good speaking with you, group. Look forward to working with them.
Great. And again, sorry for my voice, and we'll talk to you next time.
Great. Thanks a lot.
Bye-bye.